Welcome to Troutwood Live. I am Gene Natali with Troutwood. Every company and every person has a story. Each week we host a guest from a company in the S&P 500. We talk about the company, our guest's career, and their personal story. Today's presentation is a first on an important conversation, insurance basics. And let me preface that topic to our student educator audience. I teach personal finance at the University of Pittsburgh, and my college students have lots of questions on insurance. We have an incredible opportunity today to learn more. Our guest is out of Mentor, Ohio, and the company she works for is Progressive Insurance. Kristi Jancar, welcome to Troutwood Live.
Thank you very much, Gene. I brought a special guest with me today. His name is Samson, and he's our new quarantine puppy. We've had him for about 5 months now, and he wanted to say hello.
Oh my, how did you plan that yawn perfectly from Samson?
I guess he doesn't think this topic is as exciting as we do.
Oh,
Here, I'm going to hand him off to my daughter. Here you go.
Bye-bye, Samson. What a beautiful... Oh, and who was that other special guest, Kristi?
So that was Gianna, my daughter. She's in first grade, and my son, Michael, is a fourth grader, and they're both happening to be homeschooling today. So in addition to leading a team of 11 people at Progressive, I get to be a mom of 2 beautiful kids and the new puppy, of course. So there's never a quiet day here in Mentor, Ohio.
Oh, I can only imagine. Kristi, we're going to dive in more to your background. We're going to learn a lot about this topic. We had 2 observations as students were preparing for this talk. One you can take back to Progressive, that students of all ages love Progressive's commercials. We learned that.
It's great news.
And we're going to dive into a question that came in from a 3rd grader. Landon asked a question just this morning that I thought was interesting. And he said, Gene, is Progressive in the S&P 500, and what does it rank? So we're going to just quickly go to the Troutwood map and answer that question for Landon. Landon, I appreciate you, and I appreciate that question. Let me put Progressive in the search bar here. And we will, if I made an extra typo there. Bear with my typing. We're going to fly into the headquarters. Kristi, this is something fun we do. We have a fun fact for every company. Progressive was the first to let customers name their own price for insurance in 2009.
Excellent.
And Landon, there's the answer to your question, 137 as of today. And Kristi, when I see that picture, I think, boy, Progressive looks like a pretty cool company.
I will say, when we get to talk about the career side of insurance, it is not only is it a fun company to work for, we do a lot of things to show that we don't take ourselves too seriously. And we'll talk about that when we talk about some of the questions that came in about our advertising and our marketing.
Oh, I'm excited to learn more. Well, Kristi, let's dive into your presentation.
Excellent. So I will be talking a little bit about the basics and the terminology for insurance. And I know it's exciting to talk about what kind of job opportunities might be available in the insurance industry. And I've been fortunate enough to be working in insurance for about 15 years now. But let's dive into some of the basic terms first, if you could, Gene, and show my first slide here. So what is insurance? It's interesting. I gave this presentation to my kids last night, and the first thing they said when I explained what insurance was, wait a minute, Mom. If insurance means the insurance company is promising to pay me money if something bad happens, how does the insurance company make any money? And I said, that's funny you should say that, because it's an interesting concept, and I wanted to give a little bit of an example of how that works. So let's just say you're a student in a classroom. And at the beginning of the year, the teacher asks every student to put $1 in a bowl. And in that bowl, let's say it's on the teacher's desk, you see that there's now, let's say there's 20 students, there's $20 in the bowl. The teacher says, if any one of you gets stung by a bee during recess this year, I'm going to give you $5 from the bowl. So the $5 will pay for maybe some bee sting ointment, maybe a Band-Aid, whatever you might need, but we'll cover you. So every student puts in that $1. There's $20 in the bowl. How many kids do you think are going to get stung by a bee this year? Maybe 3. So let's just say 3 kids get stung by the bee. The teacher pays them $5 each. That's $15 she's paid out. Well, she still has the $5 left over at the end of the year. So that's the money that the insurance company makes when they collect the money. And we'll talk about some of these terms and what they mean. But that's how the insurance company does make their money. So they promise to pay you if something bad happens to protect you against that financial risk. That risk is really the risk that you might have an unexpected expense. Nobody plans on getting stung by a bee, so you might not bring $5 to school that day to get some ointment or a Band-Aid. So these things are unexpected, unpredictable, what we would call losses. So that's really what insurance is. It's this promise between 2 people that I'll pay you a little bit now so you can pay me more than I paid you later in exchange for that agreement.
Kristi, I've never heard insurance simplified quite like that. What a great example. One part I would add is if I get stung, the cost could be much higher than my $1, which is the benefit to me as the consumer.
That's absolutely right. So let's talk a little bit more about that. If you want to go to the next slide. So let's talk a little bit more about that unexpectedness, because like you said, Jean, it really comes down to this idea of, well, I don't know if I want to pay $1. What if I don't get a bee sting? So if I don't get a bee sting, I feel like I've wasted that $1. But on the other hand, it's going to cost me much more than $1 to cover my costs if I end up getting stung. And again, I'm not carrying that with me because I didn't plan for it. Mm-hmm. So the whole concept is really about this idea of, I don't know what's going to happen in the future. So I think it makes the most sense to pay a little bit now to pay me later a bigger amount than I'm paying in. And we can really break those terms down. But again, simplifying that concept, it's really this idea of, I'm going to get back, if I have something bad happen to me, I'm going to get back more than I paid into it.
Kristi, I love how because even as you're talking, one thought popping through my mind is a bee sting is just one thing I'd have to be worried about. There are many events, the cost of which could be very expensive if I, as an individual, was protecting against all of them.
Exactly. So if you want to flip to the next slide, I'm going to break down sort of all these different areas that we end up buying insurance. And I'll use the first one, the health insurance, to talk a little bit more about this recess concept. So the bee sting, like we said, it's a $5 expense, and this little experiment helps you understand this basic concept of insurance. But let's say in reality that accident at recess wasn't a bee sting. Let's just say it was a broken arm. Maybe you were playing on the monkey bars or fell off of something on the playground, and you end up, well, you're not sure. You think your arm might be broken, but you end up maybe going to the emergency room. There might be an x-ray involved. There's the doctor's visit. There's your follow-up treatments. All of that money adds up. So your parents are paying for insurance, medical benefits, to cover accidents like that might happen unexpectedly. So that's the concept of health insurance. There's these big accidents that might happen, but there's also just regular doctor's office visits. I have 2 kids. I know that in normal years, we have strep throat multiple times per year in the house, ear infections. All of these things end up costing money. So the medical insurance or the health insurance is going to pay a little bit each month towards that so that those expenses are covered. I did see a couple of questions come in about life insurance, which we can certainly dive into more later. But the concept of life insurance is really to cover losses related to loss of life. So if you think about that, there's a couple ways that might happen. Let's just say one of your grandparents were to sadly pass away. Your parents, these students' parents, might have to fund the cost of a funeral. At this time, that might include burial and a gravestone and all these other costs, which is really sad, but they'll want to make sure it's a really beautiful event. So the life insurance might help cover that. But the other aspect of life insurance is really this idea of covering the missing income of somebody that might be maybe not at an age where they would have been retired. So let's just say it was a house where there were two people working and one person lost their life. And now this, person has to spend all the money on the house and, whatever expenses, maybe it's college expenses, on that one income. So in that case, the life insurance is really going to come in and help support the costs that are bared by the person that is now solely responsible for paying for all of the expenses that they normally would have had two people helping out with. So that's a little bit.
Can I share an example on that life insurance?
Yeah, absolutely.
Interject. I did not have life insurance until I had a wife and kids.
Mm-hmm.
Why would I have waited until then? For the student audience, why, when I had kids, did I say, oh boy, this is really important to me now? And I actually made a bet with my University of Pittsburgh students that if 50% of them opened Roth IRAs to throw a tangent finance tournament, I would get life insurance. Take it away, Kristi. Take it back in.
Okay. And then there's automobile insurance, which happens to be the industry I'm working in now. But I also have to sadly admit that this coverage came in handy for me earlier this year. I was running around shopping for Christmas gifts. It was a December, kind of a dreary day, and I was a little bit distracted with all my errands I had to run. And I rolled into the car in front of me at a stoplight, just barely tapped their bumper. And I couldn't believe it. I got out and sure enough, there was a dent on the car in front of me. And rather than just, oh, sir, how much money do you want for the bumper I damaged? What we did is we used our insurance. I gave them the insurance information that I had. And now my insurance company is going to pay for the damages to his bumper for my silly accident that I had. So thinking about that, it doesn't always have to be these big, bad things that happen. It could be really small accidents, or they could be much larger. I've had accidents where my car wasn't drivable afterwards. In that case, I ended up getting a new car and my insurance helped pay for the new car. So automobile insurance, and really like the picture you showed at the beginning of the screen, I think the guy was on like an ATV or some really cool, what we would call like a toy, a recreational toy. We cover all of that. So boats, ATVs, RVs, whatever you want to consider that kind of vehicle or automobile, we would, Progressive or any other insurance company does cover those types of damages or losses. And then the last one would be, popular one would be homeowners insurance. And think about property damage. Maybe it's your basement flooded. I know sometimes in Cleveland area, we get big rainstorms in the spring, and sometimes people's basements fill up with water and you've got to replace the carpet and maybe repaint the walls. The homeowners insurance helps in those situations where you have these events that you can't control or that are unexpected, and you're going to have to pay for things out of pocket. So those are really the four basic types of insurance that are out there that are really important to understand, and why you need them and why it's so important to make sure you're covered in those cases of unexpected losses.
Kristi, the way you put this slide and how concisely you presented that gives, I think, educators some really good in-class assignments.
Great.
I caught a subtle, very powerful statement you made on the automobile analogy. You tied two analogies that your car insurance protected both you, but also other drivers on the road. And I think that's important for students to take away.
Absolutely. Let's just say that gentleman ended up getting hurt, and I actually was hurt in the accident where my car needed to be replaced. Sometimes you can add on to your auto insurance some other medical protection type benefits. So I don't know if everyone's familiar with the term whiplash, but that's a common injury when you have some sort of accident. And the insurance then would come in and help pay for that. I ended up getting x-rays for my whiplash. So there was doctor's visits and ended up being some physical therapy afterwards just to stretch those neck muscles back out. So that's where that coverage is so important, because like you said, it protects the driver, and also anyone else that was involved that maybe wasn't in your car. So it protects both of you.
There are consequences to not having insurance. Unfortunately, it tends to be, I think we enter the real world unprepared with insurance know-how. So I'll try to stop interrupting because this is just excellent, Kristi.
Great. So why don't we go ahead to the next slide? So these are some of the terms that I did want to break down for you guys. So let's go back to that bee sting example. The $1 that every student put in the teacher's bowl at the beginning of the year represents the insurance premium. It's what I'm going to pay now so that I am protected later. So that $1 example is considered the premium. I'm going to jump to the third bullet, which is the limits. So in that case, the teacher said, I'm going to pay at the most $5 for a bee sting. So the limit on that contract or that policy was really this $5 exchange in return for the $1 in premium. And then the deductible is what the student would pay first. And in our example, the student paid nothing. So if you go to the next slide, I really want to talk a little bit about, this is where the variances come in to insurance and how there's really not a one size fits all. So, sometimes you go to the store and you see something cool and you're like, oh, this is it. It fits everybody. That's not the case with insurance. Everybody's policy is going to look a little bit different for two reasons. One, everybody's risk tolerance is different. So for instance, I don't want to pay any money out of pocket if I get stung by a bee. So I'm going to pay you that $1. But another student might say, it's a pretty low chance I'm going to get stung by a bee. What if I gave you 25 cents in premium, but you only give me, let's say, $4 if I have a bee sting? So in that case, that $4 really represents still that same $5 limit, but the $1 difference is the deductible. So it's what the student's going to pay out of pocket or agree, I'm going to pay the first dollar towards this medical expense for my bee sting, and then the teacher will pay the other $4. So there's all these different ways that the deductible can come bigger or smaller based on my tolerance for risk, how much I think that's important to me to avoid that $5 out of pocket. And then on the other side with underwriting, this is where the teacher, or in the real world, the insurance company is saying, how risky are you? Are you wearing tank tops every day so your shoulders are exposed? Are you wearing floral scented perfume so bees are going to flock to you? So in that example, underwriters would be looking at risk factors to say, I think this person's more likely to get stung than that person because of some of these behaviors or things. So if you extrapolate that or extend that to real reality, I think some of the questions that came in were, hey, is this age range paying more in insurance? Or what if I drive this type of car? Is insurance more expensive? Those are really just risk factors. So behind the scenes, and when we talk about jobs and insurance, there are a lot of people whose sole job is to look at all those math equations and say, these things are all risk factors. So yes, if I'm a little bit of a younger driver, I might not have as much experience on the road. Maybe that's a little riskier. If I drive this car and it's super fast and it's kind of like a sports car, that might be more of a risk on the road than, say, this car. So every insurance company is going to have their own risk factors and ways they rate that risk so that they make sure they collect enough money in that pool to pay out. So that money, that $20 bowl for the bee stings, is really the insurance company saying, we better collect this amount from everybody so that if any one person has an accident, we can pay out on that. But they want to charge people the right amount based on how risky they are. So that's where you get into no one plan is the same. And then there's really these two things in play. How risky are you, but how much risk do you want to accept? I don't know if that needs any further breaking down.
Kristi, it's a fantastic framing of the insurance. As you're talking, I'm thinking, boy, if I'm a K through 12 educator, Kristi just gave me the 4 insurance types I need. Pros, cons. What a great classroom assignment. The pros and cons of having them, but also steps that I as an individual can take, not wearing flower-scented perfumes by the beehive. What a great example.
All right, we can go on to the next slide. So let's talk a little bit about insurance careers. And I had to use this meme because I love the movie Elf. And there are so many jobs in insurance. And I've happened to work both in the health insurance industry and now the automobile industry, and in very, very different disciplines. So I just wanted to throw this in there as a fun segue into the career side of insurance. And if you go to the next slide, we'll talk a little bit more about how that works. So earlier in the presentation, we talked about this idea of insurance being a promise. So you paid the teacher this $1 and she promised to pay you. But in real life, what is that? That's air, right? A promise is, maybe it's a handshake, but probably you're going to want more than that to know that the dollar I paid you is going to really be something that you can turn around and prove that you did that when it comes time to collect benefits if you have a loss. So I use this example of the box of insurance because there really isn't an Amazon shipment that you're going to get that's going to land on your doorstep and say, here's your insurance, right? So in today's day and age, your proof of insurance is a contract with the company. It's your policy contract. And if you're like me, and if you go to the next slide, if you're like me, if I have a paper contract, somebody mailed it to me, I'm sticking that in my junk drawer. So that's my drawer with all of my paper clips and all the pencils we got from the Valentine's Day cards from all the exchanges, right? So I don't know if I really want to keep my promise as a piece of paper in my junk drawer. So in this day and age, there's a lot of different ways that people want to hold on to that promise. So I might want it in my email inbox instead. So the electronic version of that written agreement is now accessible to me through my email. Or maybe I like to just log in. I don't want to keep it in my inbox. I want to log into the website and pull it up only if I need to go and find that. Or maybe I'm more of an app person. I just want to click the button on my phone, have the app launch, and see my policy coverage right there. So that's really where we get into this idea of jobs in insurance are so much more than we talked about those kind of mathematical, how do I rate the risk of this? It's, hey, how do I make sure that I can deliver to our customers the contract, the promise that they bought, and all these different ways that they want to receive the information. So it's really this idea, and I shared this with Jean earlier, when we talk about a company like Progressive, or maybe even any insurance company, a lot of us are really like technology companies that are offering insurance. So we're not necessarily a technology company, but we have so many resources and jobs in technology that you would never think of when you think about insurance. So that's really where my work comes in. And if you go to the next slide, I'll talk a little bit about that. So if you think about that contract, and maybe it's a piece of paper or maybe it's an email, at the end of the day, how inefficient would it be if somebody sat there and typed up every person's contract? So Jean, you bought the $4 bee sting version and I bought the $5 bee sting version. We can't possibly have somebody typing up everybody's individual contract details and then mailing it out to them. It would just be terribly inefficient. And that's where my team and my job comes in, is we really help manage and store the communications in a systematic way. So computer systems, computer programs. And I actually explained this to my 4th grader last night, and he came up with the best analogy. He goes, Mom, it kind of sounds like these are all little puzzle pieces that you put together for each person to make a different puzzle. So your puzzle piece, Jean, has, this premium, this deductible, and this limit, but mine has different puzzle pieces. But at the end of the day, we're both getting a puzzle. They just look a little different and may have different pieces to them. So in those pieces, those are what we would store in our systems as individual kind of pieces of the contract. And then we weave those all together and we send them out to the customer in these different ways. So that's why we want to store it electronically, so that we don't have all these inefficiencies of one person typing up each person's contract. We rely heavily on technology to help us do that.
Kristi, I have professionally sat through a lot of insurance presentations. I have never heard anyone communicate so clearly, easy to understand, but also concisely, because insurance is a complicated topic and you are
Yes.
making it the opposite of complicated.
Well, I will say that's helpful for my fourth grader. I've been joking with people lately. Remember that show, Are You Smarter Than a Fifth Grader? I am now convinced I am not smarter than a fourth grader because he's asked me the best questions about this presentation that made it much better than I think I had it starting out. But he was really engaged in this information, which is why I know it was interesting for somebody of that age range to better understand these job opportunities available that have nothing to do with the actual selling of the insurance. So if you want to go to the next slide, I'll talk a little bit about how I got into this technology side of insurance. So I used to work in the health benefits side of insurance, and I was actually in marketing. So all the fun stuff you think about when you guys talked about commercials, but there's also different ways that companies market or advertise. And I was so fortunate I was able to travel to places like Boston, Miami, New York City, Las Vegas. And my whole job at that time in marketing was to help explain to salespeople how to really understand the nuances of insurance. This concept of there's really not one size that fits all. So when you're talking as a salesperson to organizations about the health benefits they need to offer to employees, here's how you should say that because it makes it easier for them to understand. So like you just said, Jean, this idea of how do I break down the super complex topic and make it easy is how I worked in marketing. When I shifted over to this communication side, I thought, oh, sure, I'm just going into the communication side of auto insurance, not realizing how much technology is involved. And that first day, I am not going to lie, I sat in a meeting and I thought they were speaking a different language. This language that software people speak and the projects was like, it was scary. But by the third day, I was like, oh, I get it. So it was this concept of anything is going to be new and different on day one. But by day three, I understood my role was really a translator because let's be honest, they were speaking a different language. Computer programming is a language and systems are their own language with one another. And then my group and my role is we translate what the company's trying to do to these software developers, computer programmers, so they know how to make it in the system. So I get to be a language translator or a concept translator every day, and so does the team that I work on, so that the software engineers and software developers know what they should do and know how we want it to work. So that's sort of how I transitioned into technology. Was I thought, hey, I'm still working in communications, not realizing how much technology really goes into communications today.
Kristi, I love that. My college students are generally finance. So everyone that I know from the collegiate arena that got a job in insurance was a business major. You just opened a whole new arena to the young minds listening. I can pursue technology and enter in a company or a field I might not have previously considered.
And that's absolutely true. And I never would have thought I would have ended up in technology. And like I said, it was different. It was scary, but it became so easy. And that day one turned into, I'm almost 4 years later, and now I'm leading a team of 11 people that do what I did on that day one. So it's very easy to grow in that space. Like I said, there's such a need for all of the technology at these companies. There's a lot of job opportunities and a lot of career growth opportunities in these spaces. And you don't have to get a degree in technology. My degree was in economics. And so it was not necessarily the background of software.
And Kristi, I should ask, where did you get that degree in economics so we can give a shout out to your alma mater?
So I did my undergraduate at Allegheny College in Meadville, Pennsylvania.
An excellent school that I know well.
Yes, absolutely. Go Gators. And I really only have this one slide left before we get into questions. And it's really to talk a little bit more about the other aspects of insurance that we haven't hit on. So we talked about sales. We'll talk about the fun side of sales and marketing and the commercials. We talked about this concept of underwriting, where somebody's using risk factors to do some mathematical equations to understand people's risk and what they should charge people to be able to cover and make sure everybody can get paid in case of any losses. We talked about the software side, that the computer programmers are helping to weave those puzzle pieces together for the customers. We talked a little bit about this idea of consulting. I didn't call it that, but it was this idea of when I worked in the insurance, the health insurance side, the people that I was explaining, here's how you tell employers that there's no one size fits all policy out there. They would go out and explain that to companies, maybe companies like the moms and dads of the kids in the audience. So really, they don't work for the insurance company. They work for a different company, a consulting company, and it's still in insurance. But their whole job is to say, hey, you might want this insurance company, but you might want this one because they're offering better rates right now. So they kind of can sell both options or different carriers. And so they really don't work directly for the insurance company. They'll sell any insurance company. So they're not necessarily direct sales. They're this consultant that helps companies figure out what the best option is for the employees based on their needs. Mm-hmm. And then there's the risk analysis that really goes along with that underwriting piece. So the people that analyze those risk factors. So, hey, a new car might have come out that makes it less risky to drive. So maybe something with automated driving features or a lot of technology that helps, rear view backup and side view mirror cams, all those things that make driving safer play into this, the risk coming down when drivers are driving. Mm-hmm. So that's a big part of the insurance industry as well. And then the last one is really this concept of human resources. We don't think much about it, but if there's a lot of employees working at a company, you see me, I'm a mom, I've got a dog, I've got 2 kids, I've got my own stuff going on, I might have my accident or I might need my health insurance. So the human resources department helps keep us really engaged, really work-life balanced, really understanding what's available to us as employees of the organization. So they're really our internal cheerleaders, helping us stay motivated, stay understanding of what we get because we work at a company. So the human resources department is crucial. They don't necessarily play into the insurance itself, but they are a crucial part of keeping the organization's culture really strong and healthy.
Kristi, the way that you present it, the single most common question that I receive from educators, guidance counselors in the high school level is, how do I help my students prepare? Mm-hmm. Wow. You just gave a short course. There are so many excellent examples. I can tell you, I am going to have my students at Pitt watch this entire video because I have not seen insurance condensed this well.
Awesome.
We had a bunch of questions come in, which
yes.
we've narrowed to a handful. Do you mind if I shoot you some questions here?
Let's do it.
And they are a mix because it's a wide range of students in grades. The first question comes in from Enzo in 4th grade. So similar to your son.
Yes.
I want to interject because you downplayed your expertise with your own son, that your son's interest in this topic, Kristi, a testament to him, a testament to you, and to parents that might be watching this with their kids. What a great place to have a conversation, the dinner table, on topics like this. So my kudos to you. But Enzo's question, 4th grader, what are the ideas or what's the inspiration behind the progressive commercials that make us laugh?
That is a great question. So I'm unfortunately not in the marketing department at Progressive, but I will say they have a huge department. So in that department, we've got people that work on the videos, the commercials, the print advertisements, the ideas. And here's my shout out about marketing in general. I really do miss it as a career. But when they brainstorm those ideas that are, I think, very funny, and it sounds like you guys enjoy them as well, the number one thing that makes them understand that they work for the company is the measurement of how many people end up buying insurance after seeing that commercial. So let's just say they do have a brainstorm for a really great idea. This team of people says, this would be funny. Let's see if if people like it. So it's great if it makes you laugh, but the way they would measure success is if they put that on the Super Bowl and all of a sudden the phone starts ringing 10 minutes after that Super Bowl commercial runs because it was so effective at getting you to want to buy the insurance. That to them is the successful commercial. So they really want to make sure not only is it funny and you understand it, but does it make you want to go and buy the insurance? So that to them is success. So I always used to say marketing is an art and a science, because you want to understand, how do I make people like it and feel good about the company? But at the end of the day, it's all about results.
Kristi, you sparked a question. I'm going to interject one before going next to our pre-selection.
Okay.
A good question in YouTube, based on your Super Bowl analogy there. Does using celebrities help make people buy insurance? I don't know if you could feel free to say I have no idea, but an interesting question.
I personally don't have an idea, but what I would say is, based on the example I just gave, is I think it would be really fun to measure that. So you could start with, sometimes when we do measurements, when I used to work in marketing, we'd start with what we would call a baseline. So if you're running something or a commercial or a campaign and saying, this is the results of this campaign, and then you would create a trend. So every time we run a commercial or a campaign, these are the types of results I get. This is how many people buy a policy. Then all of a sudden I'd introduce a new concept, a variable. So the variable is, I'm going to put a celebrity on the commercial. Now, if you measure the results, so the times the phone rings or the people enter for the quote online, after seeing that, one could say, hey, this seems correlated that this celebrity is making us sell more. So you would be measuring all along, having that trend, and then all of a sudden introducing this new variable, you could really measure, was that effective or not?
Kristi, I'm going to add another type of job hearing your answer.
Okay.
Data analysis, data analytics.
Yes. I'm sorry. That is a huge, huge role in our company and multiple companies that I've worked for. We call it data analysis, and it's a huge and booming industry. And we use a lot of technology to help with that analysis as well. So it is absolutely a big career in our insurance industry.
I'm going to jump to our next question. Kristi, this is a good one. How does a person know how much life insurance to buy?
Okay. So earlier, and I'm not a life insurance expert, and that's one industry in insurance I haven't worked in, but my understanding, and as Gene had said about his need to buy insurance once he had kids, is really to protect the income. So a really small example I'll give you is, let's just say you've got a family and the parents are 40 years old and they plan to work till they're about 60 years old. And an accident happens, and now, unfortunately, someone is gone, and it's a single income household. That's 20 years of income that are now lost. So you were planning to work to 60. What happens? Well, really, how much money was the person making? So let's just say they made $50,000 a year. Now I'm losing that $50,000 a year over 20 years. So an insurance expert, a life insurance expert, a consultant, a salesperson would enter that into probably a computer system that would take into account the number of years they were working, maybe interest that would have been earned on that money if it were invested. And they might spit out something and say, hey, basic math, 20 years at $50,000, you should need $1 million policy. But of course, there's going to be all sorts of other factors that go into that. But that's a really simple example, as you're really just trying to protect income loss in that case.
Kristi, that's a great question that just popped up from the YouTube too. Is psychology a required course when entering the insurance field?
That's a good question. So no, I would say that there's no required fields for really any job in insurance. So there are people that sell insurance that might have certain certifications, but those are tests that I believe would come in after you'd trained for kind of sales in insurance. Life insurance mostly is one that comes to mind. There's some certifications that are required for that. But psychology as a course, no, that's not like a necessity to have a specific education background like I said, I was in school for economics, ended up working in marketing, and then flipped over to software. So your education is really just preparatory for understanding the career. It's not a must-have.
Kristi, we have another really good YouTube question from one of our classrooms. Most high school students are on their parents' car insurance. When is the best time for a student to begin exploring getting their own insurance?
That's a great question. So remember we talked about those risk factors. So each company is going to have their own determination of how risky certain age groups are. And we talked about data analysis. So what they're going to do is they're going to rely on some trends, and they're going to say, how many accidents have we seen coming in from this age group? So they start basing the risk based on the data that they have available. So if a teenage driver says, I don't want to be on mom and dad's policy, I am going to go and get a quote from this insurance company. Unfortunately, they're going to have to take whatever other benefits have been paid out from that insurance company for that age bracket into account. So that age group in general is riskier. I might not be a risky driver, but the pool of people, all the people in that age group might be contributing to a lot of claims that are submitted to insurance. Therefore, the insurance company is going to say, I know you seem like a real good kid, but unfortunately, we see a lot of accidents in this age bracket. So the best thing to do is really to start understanding this idea of getting a quote and understanding what it would cost to get you on your own insurance. Once you see that, you might understand, might be better for me to stay on my parents' policy, and they may even get some benefits or discounts based on, I know that there's certain factors out there for good grades. There's different kind of discounts available based on things you can provide as an individual versus being rated against a big group of individuals.
Kristi, you are giving so many great either homework or in-class assignments. Compare. That's a great answer to that question from Jordan Lang. Compare. What is the cost if you go on your own? What is the cost? And then you have a choice to make when you see both quotes.
That's right.
We have two more auto insurance questions. Kind of a fun one. Is it true that boys between the ages of 18 and 25 pay more for insurance than girls? And as I see that question, I'm thinking risk averse, risk taker.
Yep. So if you think about it, we talked about this concept of risk factors, and you really don't want to stereotype, but I go back to data. And I always said, how can people possibly argue with data? Because the more that it's actually happened and they take into their computer systems and their mathematical programs, they're going to be able to say at any given company how often that age group of males has had accidents compared to that age group of females. It's based on actual data. So I can't say for certain what somebody's risk factor rating is, but what I can tell you is they're absolutely using the data, the trend that's come in over time to help understand that risk factor. And like Jean said about risk averse and risk avoidant or risk tolerant, that's going to be one of those things that maybe the data would show that boys of that age group are having more accidents, and maybe it's, I'm not saying they are, but maybe it's because they're driving more or driving faster or driving different types of cars. I can't say why their risk might be more, but that's going to be where they would rate it based on the data that has come in.
And Kristi, kind of a follow or maybe of just a continuation of that statement, does the type of car you drive affect your insurance rate?
So that's another great question. And once again, I can't speak to the exact risk factors or ratings that they put on any specific vehicle, but I know from my own policy, when I bought a policy, when I had a brand new vehicle, it had all of the safety features, right? So it had rear view or side view mirror assist, so I don't have to worry about my blind spot. And it had a backup camera, and it had a front crash sensor. All of those things that indicate this car is a really safe car got me a better rate. So at some point, they're looking at this, what we're calling like emerging vehicle technology, And we're using that to help rate insurance to say, it's not just, is it a cool car or is it an expensive car? Oh, you drive a Lamborghini and this guy drives a Honda. It's what are the safety features in these cars that help them make them a safer car to drive versus maybe one that's had a winter in Pittsburgh or Cleveland and might be having some problems because it's just taken a beating over 3 or 4 hard winters. So if you buy a used car that's been through a lot of winters versus a brand new car with new safety features, yeah, they're probably going to rate those differently. I can't say how or what specifics, but certainly the details about the car matter.
In the kind of the current event, the news, the tragedy with Tiger Woods, his recent accident, what I have seen is that his vehicle saved his life. The safety features in that vehicle is why he survived that accident, to your point.
That's right.
Kristi, I think we are going to remember this conversation with how many times you have said data. It's the first time in one of our live episodes that we've heard the role that data plays. And the way you are demystifying insurance is fantastic.
Oh, good. I'm glad to hear it.
I'm going to jump to a YouTube question that is also timely, and I'm curious to engage in this question. Rachel asks, in an instance like what's currently happening in Texas, when insurance claims, obviously there's a spike because of the severity of the event, what does that mean for the insurance company and people making the claim?
It's a great question. And again, I'm not in the property insurance industry, but I will say, based on my overall understanding of how insurance works, places like what's happening in Texas, and if you think about places like Florida that might get a lot of hurricanes, I know a couple years ago there were a lot of hurricanes that came through in that area of the country. What ends up happening is those states or those places that end up taking a lot of losses, it does get factored in. So we talked about that concept of the teacher needs to make a little money on the insurance with the $20 that she collected for bee stings. Let's just say all of a sudden, we didn't know, but unbeknownst to us, there was a bee manifestation and there were all of a sudden an outgrowing of bees everywhere, and no one could have predicted it, right? Like a storm, right? That'd be the equivalent of a catastrophic storm or a hurricane. Nobody predicted a swarm of bees, a beehive got knocked off of a tree and every kid in the whole school got stung by a bee, and now the insurance company is like, the teacher's like, I lost all the money, I can't pay the money. So that really doesn't happen because of this idea of pooling the risk and collecting money. And my son asked this as well, like, do they ever run out? No, there's this concept of reserves, right? And I won't get into details on all of that. That could be another research project. But essentially, they'll factor in those losses against the entire pool of money that they've collected from everybody everywhere. So our simple example was the teacher's bowl with the $1. In reality, there's more than just the state of Texas paying into the bowl, right? The insurance bowl. So certainly it'll get factored into everybody's rates. But at the end of the day, that's just one geography playing into an entire company's factoring of what they expected to pay out. This idea of data. They have a certain amount of losses they'll expect to take or catastrophic events they might think they might have. And then for the people that are paying those or putting in a claim, I will say again, not as an insurance expert, but as a person that's needed to use my homeowners insurance, you do end up seeing sometimes after you make a claim that your premium might be a little bit more the following year because you got a little riskier. This person's okay, well, they had their house, the basement flooded when they had a big, rainstorm in the spring. So therefore they were a little riskier than the house that had waterproofing around the outside. So, that they're just a little riskier. We're going to charge them a little bit more money. So that's kind of how it works. It's not necessarily an exact science, but, one geography doesn't really take a big hit on everybody everywhere's insurance. It's more so factored in on that really broad risk pool scale.
Kristi, we have one. I'm going to, just in the essence of time, this will be our final question.
Okay.
I'm thrilled at how many questions there are on insurance, so we'll have to look at some of the ones we weren't able to get to. This is a great question. Is there a limit on the amount of life insurance a family can buy?
That's a really good question. So once again, not working in the life insurance industry, I can't speak to the exact cutoff for that. But my guess is that you would sit down with that consultant or that salesperson, and they would help run through that equation that made the most sense for any specific family. So they're going to look at that specific family's needs. So if that family, like I gave the example where there were two parents and one of the parents made $50,000, it would be cool if they said, well, I want to go ahead and get a policy for $20 million instead of $1 million. Well, I don't know if they would really even recommend that, because you're not really trying to protect that kind of loss. So your premium is going to go up the more benefit you want. So I'm not sure what the limit is, but I'm not sure someone would want to pay a really high premium for something that maybe they're not going to experience that loss. Because remember, it's this idea of how likely am I going to have this bee sting? How likely am I going to have an accident? Because let's be honest, not everybody's having car accidents every day. Not everybody's having floods every day. So to go ahead and buy more and more and more than you need maybe isn't, something that life insurance person would recommend, because you'll be paying that premium, and we're all hopeful we won't pass away before we were 60. So.
Kristi, I'll add for educators as an in-room assignment, what matters to you? When I explored life insurance, I was saying, well, if something were to happen to me, what do my kids and my wife need to sustain, the important things, food. So back in from there, and that's a great assignment for high school and K through 12 students. Kristi, I am 100% certain that you have inspired young minds. I'm going to jump us to, we always finish with a little bit of a career exploration so that students can dive in and say, I want to be like Kristi someday. And it is why we put this fun Explore Careers button on our company fact sheets, in addition to kind of fun news feeds. But anyone who wants to explore Mentor Ohio, Explore Progressive, here it is. And you'll see when Kristi and I were looking beforehand, look at the first one. Kristi, to your point, software developer, right in technology, top 2 positions listed out of the gate. But as you scroll down, there's a ton of different ways. So students, have fun, get in there, explore. And the reason I love that exploration is take the pressure off of yourself in terms of having to know exactly what you want to do at this age. Just explore the careers that are out there and the skills needed. Kristi, I always like to give the final word to our guests. So if you, instead of you and I having this conversation, you were a student in one of the classrooms, listening, engaging, what advice would you give? What advice would you give to your younger self? And this is free reign, go anywhere. Maybe just I'll put context and say financial advice, financial education for young minds.
It's a great question. I would say that my advice to my younger self, or even the kids in the classroom, or even the kids in my household, is don't be afraid to start making choices today that will pay off in the long term. So one of the things that we did is we gave our kids a little bit of accountability. So we gave them a debit card with spending, and we're allowing them to manage their own money. And it has made such a difference. And I wish that I had done that when I was a kid, because the things I thought I really wanted, if my parents had said, you can have it if you spend your own money, I probably would have made different choices about what I thought I really wanted. So we tell our kids, you can have anything you want, but it's coming from your money. And now they start saying, I don't think I really need that. And they're now seeing that money carry over month to month and seeing it accumulate. And I have all the hope in the world they'll keep that going as they get older and older. But it's this idea of transferring the decision to them so they can understand that they can buy something today for that immediate sense of, oh, I got what I wanted, versus maybe it's not important. I'm going to save it for later, or something might come along and I want more, or maybe I just want to save it. So I wish I had known that when I was younger, or at least been given the opportunity to play with money in that way.
That's it. Kristi, excellent advice. Kristi, this was so much fun. On behalf of everyone at Troutwood, on behalf of our educators and our students watching, very sincerely, thank you.
Thank you for having me.
To everyone watching, thanks for tuning into Troutwood Live, and we will see you next time.
Hey guys.